All right, it's 11 a.m. Time to get this show on the road. As usual, I'll be running through the sort of week's news from investment trust land. Then I'll be bringing on Richard Williams to talk about home REIT. And finally, I'll be bringing on this week's special guest, Simon Gurgle, to talk about Merchants Trust. So quite a bit of news, but there were sort of really three or four things we really wanted to pick out this week. And the first thing I wanted to talk to you about was Smithson. Now, this week, Smithson has announced plans to sort of roll over into an OIC. It's going to be a new OIC called the sort of Smithson Equity Fund, and they're establishing this especially for the rollover. I think the key things is it's still going to be managed by Fundsmith. In fact, it's going to still have the same underlying team and strategy. And for those that don't want to roll over into the OIC, you've got the option of a full cash exit that's NAV less costs. That's going to be offered to all shareholders for reasons I'll explain in a minute. That's actually going to be sort of quite sort of cost effective. So the reason this is happening is the board is sort of frustrated by the persistent low double sort of digit discount. It's tended to be in that sort of 10 to 15 range. They sort of considered the full range of options, tenders, conditional tenders. They consider sort of looking at rolling into an active ETF, even consider sort of managed wind down. And so they consulted with shareholders, and the sort of OIC structure alongside a full cash exit is a sort of preferred route. I think the sort of key thing is that there'll be no portfolio realignment required. I'll sort of come back to this in a minute, but in essence, because of the liquidity of the underlying portfolio, they can just literally sort of roll the thing over. Fundsmith is going to make a significant cost contribution to this, and pretty importantly, it's going to benefit all shareholders, not just those rolling into the OIC. Although the sort of way that it structures is there will be no NAV dilution for shareholders that roll into the OIC. I think Fundsmith are effectively covering the cost of establishing all of that. And actually, apparently, it's going to be sufficiently efficient that you'll be sort of well into getting 99p in the pound if you roll into the sort of cash option. Just prior to the announcement, it was trading or had recently been trading around sort of 7 to 9% discount. That sort of brought that right, and as you'll see in a moment, so it's now sort of trading around the sort of 3% or just shy of 3%, and you can see that in the sort of chart here. Obviously, this is a sort of fairly decent size. So, from the sector's perspective, it's a sort of 1.8 million market cap trust that's going to sort of leave the sector, which is a shame. However, we had a chat with Mike Balfour, chair of sort of Smithson, who Pete says, and the reason I've sort of put it on the slide, he says he loves investment companies, loves the structure. Apparently his pension's full of them. But he says that sort of Smithson is not taking advantage of the closed-ended fund structure. But there's no gearing, there's no private investments. But more importantly, and this is sort of quite a key point, there are no illiquid investments. So median market cap of the sort of holdings in the portfolio is $8 billion US. And if you sort of look at it in that context, everything that's in there would be a FTSE 100 stock if it were listed in London. Other things, no derivatives. They're not doing anything creative with income generation or distribution. And really, Mike sees little reason for the strategy to continue as an investment company. As I said, the discount is the big thing here, and they have tried very hard to narrow this. As sort of growth stocks went out in favour in sort of early 2022, they launched a buyback program, and they have put nearly $1 billion into £1 billion into that. They've repurchased 69 or basically 70 million shares, which is basically 40% of the issued share capital as at the end of March 2022. Despite buying back this many shares, there are still net sellers, and as you sort of saw on the discount slide, it's not had a huge impact on the discount. In fact, they sort of found that the only significant buyers of Smithson stock were Saba and Smithson itself. Really, something had to be done. And as I say, obviously they've consulted the big shareholders, and the OIC is the preferred outcome. Terry Smith's going to be using his 2.3% stake to sort of back the restructuring and invest in the new fund. I mean, our sort of overall view of this is it is a really plain vanilla fund. They weren't using sort of any of the things that you could and really probably should be using if you're in an investment trust. But shareholders are going to lose the board that would otherwise be there to fight their corner. And here's the kind of sort of rub, and I guess this is why Smithson or sort of Fundsmith are happy. to sort of shoulder the costs of rolling into the OIC, is fee is currently based on the low of market cap or NAV. And of course, at the moment, that's 10% lower because of the 10% discount. So effectively, you're going to be paying 10% more to get the same level of service. And to be bluntly or brutally honest, performance issues are not going to be resolved by the change of structure. Next thing I want to talk about is hydrogen capital growth, sort of formerly known as Hydrogen One capital growth. Now, for those that are following this, the shares were suspended on the 18th of September, so nearly 2 months ago at the sort of trust's request. The reason was that by that stage, it was clear that the 3rd of September deadline to publish their interims would not be met, so they were going to be suspended. Anyway, sort of background to this was there was a sort of new manager, Red Will, appointed on the 30th of July. Basically, hydrogen sort of capital growth, it's got this portfolio of hydrogen projects, but it is a growth capital vehicle. This is obviously very early stage stuff. And these things need funding. And in an environment where really, you can't raise fresh capital, particularly for these sorts of projects, there was a sort of significant tension there. They've got all these projects that need funding and they've not got the cash to do it. The sort of result was they decided a managed realization of what they've got would be best, which is why they appointed Red Will, and they decided it was best to terminate the sort of previous advisor. When Red Will took over, they met all the holdings and they got all the information they needed to try and evaluate each investment. This also included requesting some key materials from the former advisor to try and do this. Boarded out saying that there were sort of delays in receiving that information, and also in the intervening period there were material developments in some of their holdings, and all of this combined meant that it was hampered their efforts really to get the interims together and sort of fully evaluate the portfolio. This is what delayed the interims and obviously led to the suspension of the shares. Now, as of I think yesterday, HGen has published its interims, and actually it's published its end of September NAV, which should allow the share suspension to be lifted. However, the figures are not pretty. During the first half of this year, the NAV fell sort of 54.1% to 41.48p. Overall from 116.4 million to 53.4 million, and this was driven by a huge write-down of the sort of private hydrogen portfolio, driven by a couple of things. Sort of discount rates obviously had increased sharply during the period, but also when Red Bull looked at it, they felt some of the sort of assumptions were generous, and actually fundamentally, more realistic assumptions were applied across, the sort of core holdings. Now, sort of looking at the end of June NAV, which allowed pump the interims, versus the end of September NAV, there's a further 17.5% drop in NAV to 34.23 pence. The position is that several portfolio companies have value, but they still require funding, and HGen has run out of cash. And what they have found is, those sort of partners in those projects that can still stand there, and I guess others' shares want hefty dilution to continue funding these projects. So the sort of net result is HGen has kind of moved from being a growth vehicle to really a sort of special situations vehicle, but a concentrated one. Really, sort of 4 projects: Sunfire, Elcogen, Hyrock, and Strom account for the bulk of the remaining value. Obviously, this managed realization strategy makes sense, and there is clear upside if those sort of key assets can execute and they can attract capital on reasonable terms. But investors need to be aware that obviously the outcomes here are now highly sensitive to what happens in companies who are very company specific, and obviously the board's ability to voice sort of forced value destructive exits, which may happen. There's obviously certainly risk of happening because it's difficult for them to stand their corner. Last thing I want to talk about was Worldwide Healthcare's interims. Wanted to finish on a sort of higher note here. So, first sort of 6 months of its financial year, which is to sort of interims to 30 September, it returned 5% in NAV total return terms. Share price total return 10.9% because of a sort of decent narrowing of the discount. Now, this is significantly ahead of sort of what happened with its benchmark, the MSCI World Healthcare Index, of 5.3% or negative 5.3%, and this is despite sort of significant sector headwinds, which I'll come on into a moment. But obviously, this is NAV outperformance about 10.3 percentage points. And I said discount narrowed from about 12.4 to 7.4 As I said, sector has faced significant headwinds. Key things are sort of Trump's push to lower drug prices in the US. His big argument is that the US is effectively sort of subsidizing other nations because their healthcare costs or drug pricing specifically, it should be in line with other developed markets. And obviously, if this comes apart, there's this big worry about what this is going to do to their margins. And also because of this, there were potential trade tariffs targeting specific healthcare products, which is obviously another overhang on the sector. As you'll sort of see in the next slide, as markets rebound sort of post the tariff sell-off, healthcare, like everything else, actually bounced, did well, but it was still left behind, or sort of pharma specifically. Biotech, as we discussed elsewhere on the site, did particularly well. And you can sort of see it here, in case of worldwide healthcare, it did suffer, obviously in the run-up to Liberation Day, but has recovered strongly. It's worth remembering this is a decent-sized fund, about $1.5 billion market cap. Now, in terms of these results, what's actually happened here? Well, specifically, and this is sort of a benefit of active management in this space, it's sort of got a long-standing tilt away from large policy-exposed pharma and towards high-growth areas, and these have done well. The other thing that sort of did well is it's got this proprietary sort of basket of M&A targeted biotech names, and that did well. And that accounted for over half of the return during the period, and it highlights the value that's been available in the sector. I think it also did well out the Carthew Life Sciences IPO, which also brought down the level of the unquoted holdings as well. But this is kind of the really interesting thing. If you sort of look at the view, managers feel that obviously healthcare has for some time been climbing this wall of worry around US drug pricing. And then in 2025, you threw in tariffs and actually further political noise from the Trump administration. However, they think these recent Trump RX deals that have been struck with sort of Pfizer and AstraZeneca could be a significant breakthrough. They say that these appear to resolve many of the sort of worst case fears on tariffs and pricing, and they still allow the industry to earn an acceptable return. And we think if this is true, healthcare could be moving past a sort of major overhang. At the same time, obviously, you've got innovation in biotech, medtech, and obviously Asian healthcare, and these all appear to be gathering pace. And if this all comes to pass, the sector could be well placed to outperform. It's food for thought. Right. Now I'd like to bring on Rich to talk about Home REIT.
Thank you, Matt. Yeah, so just really quickly want to cover off Home REIT. So I think, I hope most people are up to speed with what's gone on here, so I won't cover that. But they did announce this week that they have agreed or were in exclusive agreements with Patron Capital to sell the majority of its remaining properties, so about 700 for 123 million. Now, this is a 10.5% discount to their most recent valuation, which was at the end of August. And obviously, they, like with all of these, they say there's no guarantee that will go through and stuff. But if all goes to plan, it expects this deal to conclude by the end of this year or early next year. So there's a remaining portfolio of about 150 or just over. And they say that was valued at 18.25 million at the end of August. But this comes a couple of weeks after they did a sort of a trading update where they said they were in negotiations to sell the whole portfolio, and they expected that to conclude by the end of this year. So not 100% sure what's happened there, but it seems like this, if all goes to plan, this big chunk of its portfolio will be sold off. So good progress there. If we go on to the next slide. So I've just done some this is very back of the fag packet sort of maths, because they've obviously not released their accounts for a long time. So I think the most recent is the 2024 accounts. So I've sort of taken some assumptions there. So this sale, and then if we did this sort of same sort of 10.5% discount on the remaining portfolio and the cash, and then the side of the cost is really sort of, I've had to sort of dig around and come up with some assumptions there. So they did a new management fee. That's probably going to be less than $1 million, but it could be, it's capped at $1 million, and that's fixed until August next year. And then other costs up to 3 million, and then legal fees is where the big thing comes in, as I'll come on to in a minute. And the most recent info we've got on that is in the year to August 24, where they spent just over 7 million on legal fees. That could go up, and then could go up massively if things develop on that side of things. So a rough estimate, about 17.4p per share. That's very rough though. And and we move on to the next slide, that all becomes irrelevant. You could just strike a line through that slide really, because like I said, there's a couple of lawsuits that are going on in the background. So there's the class action lawsuit from Harkers Parker, which against the company, which is backed by a lot of shareholders have sort of jumped on that, which the company has said that they're going to vigorously defend. Not sure quite what their defence is going to be. Can't really think of one. So we'll see what happens there. The company is also suing the former manager, Alvarium, and then you may have seen a couple of months ago that has now gone into administration. So that may sort of frustrate them on what they can get out of the former manager. And also going on in the background is an FCA investigation, which they'll obviously need to lawyer up on that to make submissions to and stuff. So, and there's been a complete lack of any updates on any of this action going on. So it's impossible to assess the outcome and the likely cost to the company. But they did cancel their share premium account earlier this year. So they now have a special distribution pot of around, or just under 600 million. How much that will go to shareholders in the lawsuit, how much will return to all shareholders, is very much up in the air. Like how long's a piece of string, really. So good update on the sale of the portfolio. Obviously 10% discount's not great to already very, very heavily discounted properties, but we do need an end game here, really. So seems like we're getting closer, but it could drag on for many years if this lawsuit goes through the courts and back and forth and stuff. So we'll have to wait and see. But there's the update there on Home REIT. Thank you. Back to you, Matt.
Thanks, Rich. That's really, really helpful update. Be interesting to see where that goes. I think this could be quite a long-winded process.